Well, good afternoon, ladies and gentlemen. I say good afternoon to those of you who are, of course, located in the Eastern time zone, as I am. I should also say good morning to those of you that are joining us from the Central time zones, the Mountain time zones, or the Pacific time zones as well. And, of course, we'll say good evening to those of you who might be joining us from across the pond there, maybe parts of Europe, Australia, or parts of Asia. Welcome to today's presentation for radioactive trading. As you saw in the email, Kurt may or may not be joining us today. I'm not real clear on that, but he may be jumping in a little bit later. But we're going to start off with something different today, something that you might not have seen before. And what we're going to do today is we're going to go through the initial RPM setup. We're going to show a basic example of that using the SLW example that Kurt referenced in the promotional email you received today. We're going to discuss the three core principles of radioactive trading. Why do we set up the position in this way? Why do we look at it this way? The three core principles we're going to introduce and discuss briefly today are described in full detail, of course, in the blueprint and in the Foundations of Radioactive Trading video CD that Kurt sends for free to investors who purchase the blueprint as well. Then, as promised, we're going to discuss that SLW trade, where we started off with a limited risk of only about 7%. We're able to bulletproof the position, meaning we canceled that 7% risk within the first 45 days, and we're able to realize outsized gains as the stock moved up using the various income methods that are discussed in the blueprint. Actually, we only used two. We used income method number 1 and income method number 4, and we'll show that as well. And if we have time later on, I plan to, of course, handle your questions as we go through the presentations. And I'll try to leave time at the end. Now, I'm going to try to check the question pod. If you have questions during the presentation, you send them in. I'm going to check over occasionally to view it. But since I'm flying solo today, I'm just going to try to take breaks in between certain parts of the presentation to open it for questions. So it'll be easier for me if you hold your questions to those points. Simply because normally when we do these presentations, Kurt's hosting, I'm able to answer the questions, but today since he's not with us, I'm not going to be able to do both. But I'll still leave time in between parts of the presentations. If you have questions or thoughts, send them in, and then we'll handle them at the end as well. So let's go ahead and get started. Now, for those of you who are just getting started, or maybe you're not familiar with it, let's talk first about what is radioactive trading. Well, radioactive trading is a unique trading technique developed by Kurt Frankenberg. Kurt started off his options trading and options investing experience, unfortunately, the same way many of you might have as well. Kurt took a weekend seminar, paid close to $3,000, maybe $3,500, to learn how to trade covered calls, calendar spreads, and credit spreads. Well, Kurt went on his way, and in his first month he had good returns, and in his second month he had good returns, positive returns as well. And then his broker told him, you're doing so, or not his broker, I apologize, his guru told him, you're doing so well, Kurt, you should really trade these positions on margin. So Kurt went into a position that I wouldn't have suggested he went into at that time. This was back in 2001. He went into a biotech stock that had really rich premiums, high volatility, and he did it on leverage. Well, long story short, the stock completely collapsed, and Kurt essentially, on a margin call, lost all of the money he had set aside at the time to invest. Well, Kurt didn't give up. He decided that, well, the money he lost didn't just disappear. It went somewhere in the market, and he started researching what the prominent successful traders say is the key to success. Gentlemen like Warren Buffett, of course, and others. And you've all heard the axiom, of course, cut your losers short and let the winners run. Oh, that's bad grammar there. But, yeah, sorry about that, the apostrophe there. The radioactive trading technique, we focus on limiting our risk first. We enter a position where we know we have a single-digit risk that's guaranteed. What I mean by guaranteed is that it's stronger than a stop order. A stop order is really a market order where you tell your broker to go ahead and close your position if the stock drops below a certain price. And not only close the position, but close it at whatever price you can get. Using the setup that we use in radioactive trading, that initial setup, we are guaranteed that even in the worst case scenario, if the stock drops to 2 cents per share or 1 cent per share, we're still guaranteed to have only single-digit risks. And then we use the 10 different income methods off of that initial setup to lower the at-risk amount and potentially bulletproof the positions. And we're going to see that in the second half of today's presentation on the silver wheaton example. But what we're focusing on here is we're going to cut our losers short and we're going to let the winners run. Now I'm going to introduce myself, and then I'm going to launch a quick poll to allow everyone here to introduce themselves to me, so I have an idea of who we're talking with here. That'll help me pace the presentation. My name is Mike Chupka. I'm the Director of Education here at Power Options. And Power Options is a patented suite of search and analysis tools that was developed by Ernest Renner about 14 years ago. And we support over 23 different option strategies. And I started out the same as Kurt did and most of you. I didn't pay the $3,500 or maybe even the $10,000 to take a weekend or a 3-week seminar, or 2-week seminar, excuse me, on learning how to trade options. I learned covered calls investing first, compared it to naked puts, which is a parity trade, suffered some losses as well, had a few months of gaining 3%, maybe 2.5%, and then 1 month giving it all back, and then spend 3 months making 2.5%, 3% on my positions, then giving it all back as well. And so I started to switch into other strategies, diagonal calendar spreads, credit spreads, and collars as well, standard collars, when I started investing. Now, I came across Kurt's techniques 3 years ago. He was a customer of Power Options, and he called up for a coaching session to learn how to use our historical suite of tools. And I've been trading radioactively in about 50 to 60% of my accounts since about 3 years ago. It was really 3.5 years ago we came across Kurt. And I have transferred most of my portfolio into RPM positions. I still trade standard collars in about another 20% of my account, and occasionally I'll have a few credit spreads open on the broad-based indexes perhaps, or maybe the ETFs as well, for just a little bit of premium on a monthly basis. But most of my portfolio is following the radioactive trading techniques as discussed in the blueprint. And because I've been able to limit my risks, I never suffered with radioactive trading techniques a 25% loss or a 15% loss for a sudden drawdown on the stock, or having a spread go against me which might wipe out 10 previous spread positions. I've had more success than I had with covered calls, than I have with standard collars, even diagonal spreads, and the credit spreads as well. Okay. All right, so let's talk about, before we go into the initial setup of the RPM, I just introduced myself and gave you a little bit of background of Kurt there, but let me get a little bit of background of everyone here. And what I'd like to know, of course, is how did you come to be here today? Did you hear Kurt speak at another event? Did you find or come across radioactive trading through an internet search or through Google? Are you currently a Power Options subscriber? I recognize some of the names here on our list, so some of you are Power Options subscribers, of course. Did you hear this from a friend? Or did you just see it on basic forums, perhaps, or looking through other searches as well, coming across message boards? Okay, this poll, thank you for voting, everyone. You guys are coming in very quickly there, getting your votes in very quickly. I do appreciate that. I'm going to leave the poll open for about another 10 or 15 seconds. Okay, let me go ahead and close the poll. Let's share those results with everyone. Looks like 22% of you have heard Kurt speak at another event. 28% of you found Kurt found radioactive trading, I should say, through Google or basic internet search. 11% of you are Power Options subscribers. 17% heard about radioactive trading from a friend. That's fantastic. And 22% of our attendees today came across us through other forums. All right, let's go ahead and hide that poll. And I'm going to follow this up with a second poll. And we might get into this a little bit of the second part of this presentation later on. I have some comparisons here on this particular presentation where we discuss the comparisons of entering a radioactive profit machine, instead of doing it this way, entering it as a maybe a naked put position or substituting a long call. We have some discussions on that. But what I'd like to know now is what are you trading? What are you investigating? Covered calls or naked puts? Are you looking at long calls and puts? Are you doing vertical spreads, diagonals, and condors? All right, so we have that two-way tie here. Oh, no, okay. We did have a tie between covered calls and verticals. Now it's back again. Okay, we've left the poll open for about 45 seconds. I'm just going to leave it open for another 5 seconds. If you haven't voted yet, go ahead and do so. So 5, 4, 3, 2, 1. Votes are still coming in. But let's go ahead and close that poll. And, okay, I'll share the results here. So it looks like the winners are covered calls and their cousins naked put at 59%. Okay, so income method number 1, which we're going to discuss on the SLW trade, we'll talk about that a little bit. We use covered calls in a sense, but we do it in a different setup. We do it with the protection already in place and after the stock has moved instead of anticipating that the stock is going to make a move. 50% of you are doing long calls and puts, and 50% are doing the vertical spreads, diagonals and condors. All right, fantastic. Okay, let's go ahead and hide that, and let me just check something quick here. Okay, I won't get into that right now. Let's go back to our main screen here. Okay, so let's talk about that initial setup of an RPM. Where do we start when we're trading radioactively? Well, what we're going to do is the radioactive prop machine, this is what we call an RPM. It's a unique form of a married put or a protective put. And most of you are probably familiar with that. You've heard from your free information at your broker perhaps, or maybe read something online about how a standard married put or protective put position is you're going to buy stock. Let's say we buy stock at $50 per share. And at the same time, we're going to buy an out-of-the-money, an OTM near-term put. So today I might buy a stock at 50, and at the same time I might buy a December 45 put, and I might only pay maybe 80 cents, maybe 50 cents for that put, depending on the volatility of the stock, maybe $1. Now, the problem with that setup is that we are paying into a low amount of time premium. We're paying a low premium for that out-of-the-money near-term put. But in order for the insurance to kick in, the stock needs to drop $5 in this case of a $50 stock, or 10%. So we're still taking a double-digit risk. We're taking maybe a 12 or 15% risk on the position. Now, the way we like to set up the married put in the radioactive profit machine, or the way we set up the radioactive profit machine, is we're going to buy stock and we're going to buy an in-the-money put that is at least 5 months out in time. Now, this is different from the initial setup, of course, you might have heard or read about on a married put, but there's a reason why we do this. Okay, we're going to take advantage of the 3 core principles of radioactive trading. Now, this is a bullish strategy. The initial setup is a bullish strategy. We are looking for stocks that we're expecting to move up in price. The income methods, if we're wrong, the income methods allow us to make adjustments or potentially reduce our risks if the stock starts to fall in price when we first open it. There are 10 different income methods. 5 or 6 of them are basically used when the stock moves up in price. There's 3 that are typically used if the stock stagnates. If I first open an RPM and buy the stock at 50, maybe buy a 55 put that's 5 or 6 months out in time. If the stock trades right at 50 for the first month or maybe the first 45 days, there's 2 or 3 income methods I can use if my sentiment is the stock is now stagnating. And if the stock falls, of course, there's a couple adjustments you can do there as well to potentially lower the risk or readjust the position. But this initial setup we're looking at is a bullish. Now, Frank did pop in a question while we were talking, and Frank wanted to know, do you have any strategy for folks like me who are generally bearish on the market? You can apply the radioactive trading techniques to a bearish market. It's discussed in the blueprint. And you would think that, okay, well, why don't I just reverse it if I'm bearish? I can do the married call position. I'll short the stock, buy an in-the-money call that's far out in time. Well, we don't advocate doing that. And if you short the stock, you're borrowing from your broker, you're going to have to pay a monthly cost to short the shares, all right, to borrow the shares from your broker. So shorting the stock and doing the in-the-money call to try to use the the radioactive techniques in a bearish market, we don't really advocate doing that. There are other ways that you can look at it by using options, of course, to mimic the bearish setup of having a limited risk, but not over-trading. We'll talk about over-trading in a little bit. And, hey, the advent of all these new ETFs we've seen coming out here, if I'm bearish on the market, I could set up an RPM on a bearish ETF, on an inverse ETF, and take advantage of the techniques so I don't have to think backwards. I'm still in a married put, but I'm in a married put on a security that's going to move up in price as the stock falls, or as the market falls, I should say. Okay, so I wanted to answer that question, Frank, but we are looking for stocks that are bullish. Here's a basic view excuse me, of a radioactive profit machine. I think this date is off, and I apologize. Oh, no, this date is correct. I'm sorry. Here's a basic view of an RPM. This isn't the Silver Wheaton setup. We're going to look at that in a little bit. PXP, Plains Exploration, on June 20th, 2011, was trading at $35.08. Now, if I was doing the basic protective put position, I might have considered buying a July 30 strike put for perhaps maybe 50 cents or maybe 80 cents or so. The problem with that position is that if I bought the 30 strike put for 80 cents, yes, I only paid 50 cents, let's say, to get into the position, but now the $35 stock needs to drop 5 points before that insurance policy kicks in. So I would lose $5 and the 80 cents. That would be my risk, $5.80 off an investment of about $35.80. That's too high of a risk to take. Plus, my insurance runs out in 30 days, 35 days. So what we do radioactively is when we were looking at this position on June 20th, 2011, bought shares of PXP at 35.08 and at the same time bought a January 2012 40 put for $7.25. Now this makes the total investment $42.33. That looks expensive, doesn't it? I've essentially paid, well, let's call it close to 20% here of my underlying security for an insurance policy that's out about 7 months out in time. Now, we bought a 40 put. We do have $42.33 invested in this position. We're guaranteed $40 back at any time, even if the stock collapsed to 2 cents per share. We have the right to sell our shares of stock at any time between now and January expiration for $40. So the total at risk amount is only $2.33 or 5.5%. Now, this is important because all we're risking is the time premium. The time premium of this particular option is $2.33. The remaining $4.92 is intrinsic value. The stock's at 35. We're buying a 40 put. So the difference between the $35 and $40 would be $4.92. We're not risking the entire $7.25. We're only risking the time value portion of this percentage, which is $2.33 or 5.5%. Let's say we were wrong on this stock after we did our research and analysis. It just happened they come out with some bad earnings, and in the first 30 days the stock dropped down to $28 per share. I've seen this stock go as low as I think 26 in the time I've been in this trade. If I just bought the stock at 35 and I bought the July 30 strike put, and near July expiration the stock was trading around $28 per share, well, I've realized that full $5.50 loss, let's say. Okay, it's much higher. It's a much higher loss, and it was only 1 month of protection. Now I have to consider buying, selling to close maybe that initial put, if I did it with the wrong setup first, the out-of-the-money near-term put, and then buying another one, or just taking my loss at that time, which would be in the double-digit range, way too much to risk. This allows us to go into a limited risk position, a single-digit risk position, and we have up to 7 months to make adjustments or to allow the stock to go up in price. We're going to take a look real quick at this position on the Power Options tools. This is the custom spread tool with a profit and loss chart. And we're just going to take a look at this with 100 shares at 35.08. We're going to buy one January 40 strike put for $7.25. Our total monetary investment, $4,233, guaranteed by the put. We're guaranteed the right at any time between now and January expiration to sell to close our 40 strike put for to sell our stock at $40. Okay, so our maximum risk is only $2.33 or 5.5%. Okay, so here is the standard profit and loss graph of the married put. You're all familiar with this, and some of you might even say, hey, that looks pretty similar to a long call position. We might talk about that later on if we have the time, but it's not. There's a subtle difference. Okay, so we'll talk about that later on. But what I want you to focus on here, remember, we're looking at this position on 6/20. Okay, 6/20 is a little bit later when the screenshot was taken, but June 20th, 2011. And the profit and loss chart, our hockey stick chart here, limited risk of 5.5%, unlimited upside profit potential to begin with. And this is at expiration. Remember, that's 7 months away. It's January 2012 expiration. The break even here, this sort of purple vertical line I'm trying to highlight next to here, is 42.33. Is that the true break even? Well, yes, it is. If we hold the position all the way to January expiration, 7 months away, we make no adjustments, we would need the stock to be trading at 42.33 to break even. Are we planning on holding the stock all the way to expiration and making no adjustments? No. We're going to use the 10 different income methods as the stock moves up and down, and I'm probably not planning on holding this all the way to January 2012. Typically when I open an RPM, I might only have it open for 3 or 4 months. But what I really want you to see here is this curved red line. The curved red line is showing you the profit and loss for this position essentially at the halfway point, 10/27/2011. And as you can see, do I need the stock to be trading up at 42.33 on October expiration to realize a profit? No, if the stock was trading at 42.33, we'd have about a $100 or $200 profit in the position. When we set up the RPM by using the in-the-money put that's far out in time, the put is not going to react one-to-one with the stock. We are giving up some delta. The initial put I open up that's in the money, in this case, when we bought the stock at 35.08 and bought the 40-strike put, my delta might have been around negative 0.7, meaning I'm going to lose 70 cents on my put for every dollar the stock moves up. But as the stock moves up a point, I'm still gaining 30 cents positive delta. And as that stock gets closer and closer to $40 or close to the put strike price, the delta is going to continue to drop. So I'm always gaining delta when the stock is moving up, even though we bought the put. We're not losing one-to-one. And by the way, when you first open this married put position, let me go back 2 slides just to the basic 5-line setup. I'm sorry. There we go. When I open this position, I'm not down $2.33 right away. Okay, I'm not $2.33 behind the 8 ball. I'm not driving a brand new car off the lot and having it depreciate 15 or 20% of its value right away. When this position was opened on June 20th, 2011, bought stock at 35.08, bought the January 2012 40 put for $7.25. I could have turned around and liquidated the position. I could have sold the stock for $35.10 or $35.06, wherever it was, a second after I opened the position, and I could have sold to close the put for maybe $7.20. When you open an RPM, you're not behind 5%, you're not behind 8%, you're not already down 8%. All you're down when you first open the RPM is your commission cost and the bid-ask spread of the put option. Okay? And the put's not going to decay one-to-one with the stock. All right. So what does this do? Well, creates a low-risk position. We have, in this PXP example, we have only a 5.5% at risk. We have an insured stock position. It results in a positive delta, and it takes advantage of the 3 core principles of radioactive trading. This is out of order from what we're going to show, and I apologize for that, but it takes advantage of the 3 core principles: FIST, force an ideal size trade, the red line, the time decay line of an option, and the at-the-money bell curve. I think how we're going to show it, sorry about that. I think how we're going to show it today is FIST is number 1, forcing an ideal size trade. Then we're going to take a look at the at-the-money bell curve, and then the red line. This is just going to be a quick basic review or introduction of the 3 core principles. And as I mentioned, investors, who purchase the blueprint will receive the Foundations of Radioactive Trading CD for free with their purchase, and that'll go into these 3 core concepts in more detail. And also Fusion members can see the various lessons that Kurt put together where he goes through these 3 core principles as well. Okay, now the initial setup, of course, 2 basic components of the RPM. We're long stock and we're long an in-the-money far out put based on the rules of the blueprint. And this allows us to take advantage of the 3 core principles. Okay, so we have force an ideal size trade. By purchasing stock and the put option, we are forced not to overtrade or overinvest. We saw that the risks are limited to single-digit amounts. In that example that we saw with PXP, our single-digit risk was only 5.5%. The silver wheaton trade we're going to go through at the second half of the presentation is the initial at risk was only 7%. Okay. Russ just chimed in. Russ was finally able to log on. He had some issues. Am I archiving this? Yes, I am. This presentation is being recorded, and I most likely will replace 2 other presentations that we have already archived with this one as well. So yes, Russ, I'm going to do that. It's going to be archived. Okay. Emmett, I'll take your question at the end. Hopefully you're still here. I don't want to get into that right now until maybe we go through some of the other things. And actually, yeah, if I don't get to it, we'll respond over email. That's probably a better question to ask via email. Emmett's looking at diagonal calendar spreads and he sees that it's possible to bulletproof those. It is and it isn't. It's a tricky way. It depends on how you adjust the position. Using a diagonal spread where I'm buying an at-the-money or in-the-money long call option and selling near-term calls against it, can you eventually get it bulletproof? Yeah, but you have to cover the whole cost of the call. So if you're only buying a call that's 3 months out in time, it might take you the full 3 months to pay for that initial premium if you don't get called away. Okay. Okay. Another quick question. Sorry, folks, and we got to move on here. Oh, Russ, I'll probably handle that question later on as well. Okay. We'll probably take that. All right. So let's do that. And real quick, I'm sorry, guys. Helmet asked, when are you doing a credit spread, calendar, or iron condor? Helmets, we're not discussing that today. We're discussing the radioactive trading techniques. At Power Options, I host open discussion presentations Friday afternoon where we discuss other strategies and ways to manage them. We do use credit spreads. Some calendar forms can even be used, and iron condors in the radioactive trading technique as well. All right, so let's move on. Now, what do I mean by forcing an ideal size trade? We're forced not to overtrade. Let's say we all had $5,000 to invest, and on June 20th, 2011, I looked at the PXP married put position where I could buy stock at 35.08 and I could buy a put option for 7.25. Okay, so that we saw made our total investment $42.33. Well, if I only have $5,000 of free capital, I could only do 100 shares in one put, so I'm only risking the $233 or 5.5% of my total invested capital. You have $5,000 to invest, and you say, okay, well, I see that married put profit and loss chart. It's kind of akin to a long call. Maybe instead of what Mike and Kurt did, why don't I just buy the January 2012 40 strike call option, which might be priced at around $250 or $260. Okay, so you go ahead and you look to buy one contract for $2.50. Well, if you buy one contract at $250, your risk is 100% of what you invested, but it's still close. My risk is $233, yours is $250. Now, with $5,000 of free capital, are you disciplined enough to only buy one contract and keep the remaining $4,750 aside so that you truly are only risking 5.6 or 5.7% of your capital that you had to trade? What most long call investors will do, they'll say, okay, well, let me look at this position. They were forced into a trade to buy 100 shares of PXP in one January 2012 40 strike put. They invested $4,200. Well, I'll tell you what, why don't I go ahead and buy 5 contracts at $250? Well, now you're risking $1,250. Maybe you do only buy one contract, okay, one of the call contracts, the January 40 call contract for $2.50, let's say. But then you say, okay, well, then I'm also going to buy 2 contracts of this call, 2 contracts over here. I might buy a put on this index just in case for a hedge, or maybe buy calls on the VIX. Well, you're investing more of that $5,000 in capital. You have more at risk now total of the capital that you started with, where we're still only risking 5.5%. Okay, the ATM bell curve. Well, both the initial setup and the follow-up income methods allow us to manipulate time value in our favor. As we're going to see in the ATM bell curve in a moment, we want to sell premium dear and buy premium cheap. And then, of course, the red line, the time value decay, is the proper approach for using time value to our advantage. Okay, if I just bought the 1 month out option on that standard married put position, I'm going to realize a very rapid time decay. Even if I bought a call that's 2 months out or bought a put that's 2 months out, I'm going to see a very rapid time decay. This is why we're going 5 months out in time. Forcing an ideal size trade too large of a risk is absolutely devastating. Okay, we want to avoid the lie of leverage that comes with certain things such as long call investing and even diagonal spreads, as Emmett brought up before. You have to be really disciplined when trading those strategies to make sure you're not risking too much money on any one position. Okay? Now, at the same time, having the risk too small is a problem as well. Okay? If I told you that I had 100% gain on my last position, you might say, well, Mike, that's fantastic. Your next question would probably be, well, how much did you invest? Oh, I only put in $100. Okay, so you still made 100% gain. I still made 100% gain. That's fantastic. But did I really put enough into the position to make it worth my while, even taking out commissions? What if I have only invested $50? Would that have covered my commissions if I had 100% gain? Okay, and I bring this up. I have a couple of customers at Power Options I know who specifically trade deep out of the money long calls, maybe 3 or 4 months out in time for profit. At any given month, they're probably trading 20 to 30 different positions. They're buying long calls that are maybe only 5 or 10 cents premium because they're so far out of the money. This type of trading is not for every investor. I don't know if they're doing well or if they're doing better than other trades, but they accept that they're going to be wrong 95 to 98% of the time. They're expecting to lose 9 out of 10 times with this out-of-the-money call approach because they're hoping that the 1 or 2 positions they get right pays for the 20 or 30 losses that they had. So they're investing 5 cents, buying calls at 5-cent premium. Hey, if it moves up 5 cents, they make 10 cents. Fantastic. They made 100%. But is it really worth it? Okay? And the biggest reason for having just the right size is to impact expectancy. Let's talk about another basic example. Stock's trading at $50 and we're looking for insurance policy. Okay? So let's say that we're going a little bit out in time. We're going to go 4 or 5 months out in time. Well, buy our stock at 50 and we buy the 40 put for $3. Okay, this is because it's far out in time. We're not looking at a 1-month output here. We're looking 5 or 6 months out in time. So our total investment is $53, but we've only got a 40 put. We're risking $13 on the position, or 24.53. Let's just call it 25%. If you suffer a 25% loss in your position, you're going to need a 33% gain to get back to break even. If you suffer a 33% loss in your position, you're going to need a 50% gain just to get back to break even. It's a very slippery slope called gambler's ruin, or the martingale. Okay. Now let's look at a possible radioactive trading setup. We buy the stock at 50. We buy the 60 put for $12.75. So now we've got a total investment of $62.75. But remember, we're not $12.75 down as soon as we open this position. The break even is $62.75 if we hold the position all the way for the next 5 months, make no adjustments, and the stock's still trading below $60 per share. Now this is a reasonable risk of only about 4.4%, and the probability of finishing above the strike is probably around 60%. Now that's farther out in time. Okay, so it's not, and the at-the-money option usually has a 50% probability when you're 1 month or 2 months at a time. When you go 6 or 7 months and you're expecting a bullish market, you probably have a good chance of the stock finishing near around 60, moving up 10 points in that 7-month time frame. And that's just bare minimum, of course. All right, now, could we go deeper in the money? Absolutely. We'll start go a little bit in the money, have a 5% risk. Couldn't we go deeper in the money and have less than 1% risk? Well, let's take a look here. Buy the stock at 50, buy a deep in the money 75 strike put for $25.75. Our total invested is $75.75, so we're only risking 75 cents. Less than 1% probability of finishing above the strike, of course. We have very low probability or expectancy. But we're risking less than 1%. Isn't this the goal? Isn't this what we want to have, is to have a really low risk position? It's too low. Okay, going too deep in the money is such a lower expectancy of a potential profit, okay, that it's just not a good idea. It's kind of like the 3 bears, all right? We kind of want to be in the middle to have a reasonable at risk amount, a single-digit risk. We don't want to take double-digit risks on our positions to protect our capital and get caught in that martingale slope, the gambler's ruin. We don't want to take too little of a risk because then we'll have too low of an expectancy of profit. Now here's an example of the silver wheaten positions on May 21st, 2010. The position that we're going to analyze later was this particular strike, but we had a 7% risk. We were able to buy stock intraday, I believe, at about $17.50, and we bought the put option for about $4.30, I believe. So our risk was 7%. It was $1.50 total, and it was 7%. This was at the close of day on May 21st. So right around in this area, and even maybe the 4.3%, this is where we want to keep our focus. And actually, I would suggest that right in this area here, let me clean that up a little bit, folks, so I don't confuse you. My apologies. Right around in here is where I'd want to keep my focus. And another reason why that you'll learn in the blueprint is we typically don't want to go more than 20 or maybe 25% in the money because we don't want to lower our expectancy too much. So right around these single-digit risk levels. Now, other stocks you might see, silver wheaten is a little lower price stock at this time. It's a little bit more volatile. If you were looking at IBM, you might be able to go as far as, you might be able to go only 4 or 5% in the money and still have a low risk because there's such low volatility on something like IBM, Bristol Myers perhaps, Kraft, for example. So you may not need to go as deep in the money. The stock's at 17.82, and we're looking at the 21 strike put. It's 17% in the money. to get a risk down to 8% or 7% or so. Not all stocks are going to have that same setup. But you see here, as we go deeper in the money, we're almost 100% in the money here with the December 35 call, and it's only risking 1.2%. It's a very low risk position, but we're 96%, almost 100% in the money. This is a very low expectancy of profit. And of course, if we just wanted to go slightly at the money, now let's say we looked at the 17 strike put option, we have a risk now of 16.7%. Okay, so that's too high of a risk to take. We don't want to go into that double-digit range with our at-risk amount when we're looking to purchase insurance. Okay, so that's just an example there, and we're going to come back to this on the silver wheaton example. But this is sort of the forcing an ideal size trade. We don't want to take too little risk, and we don't want to take too much risk. There's a proper way to set it up, and that's discussed in the blueprint. All right, moving along quickly here, the second principle is the at-the-money bell curve. What we're going to take advantage of here is not only using the at-the-money bell curve to help us set up the position properly, but also this is what we're going to take advantage of when we do those income methods, the 10 different income methods that we use to lower the at-risk, potentially bulletproof the position, and earn extra income. Okay? Now, it sets the first standard for what Kurt calls buying time cheaply and selling time dearly, as well as selling time value to quality premium. Okay, this is depending on the way we set it up in the income methods are just depending on the time value. Now, the at-the-money bell curve, you've probably all seen this before. If you look at any option chain, the time value of the at-the-money options is always the highest, not the price. Okay, the deep in the money options are going to have a higher price because you're going to have intrinsic value and some time value or extrinsic value. But the at-the-money option is always going to have the highest time premium. If we had a stock at 50, we looked at the 50 strike call or the 50 strike put, they will have the highest time premium. So when we're buying for protection, we're going to want to buy in the money or out of the money, so we're paying less time premium. Now this graph that Kurt has, this is actually for a call. And so for the stock was at 50 here, and up here we're talking about $65, and down here we're talking about $45, okay? For a call, that would be in the money. The intrinsic value would be higher, but the time value would be lower. And as we go further out of the money on the call side, well, the time value is going to be lower. We don't have any intrinsic value, and the time value is going to be fairly low as compared to at the money, of course. So we want to buy when a call is out of the money, potentially, or the put. The protective put we're looking for is in the money. Okay? Now, where do we want to sell? Well, we can see where we'd want to sell. We want to sell at the money. Okay? We want to take advantage of the swelled time premium. This is also going to help us with income method number 4 that we're going to take a look at on the silver wheaton trade as well. Now here's just a basic option chain from Power Options for Apple. It was on 3/14/2011, March 14th, 2011. Apple was at $354. Well, let's call it $353.56 here. I apologize. But $353, $354. And we're looking at the April series. Now, the column here for the calls, we have our calls on our left and our puts on our right. And we're looking at the percentage time value. Well, the 355, the at-the-money call, of course, this is where we have our highest time premium. And on the put as well. 3% time premium on the put, 3.1% time premium for the 355 call. As we go deeper in the money on the call side, out of the money on the put side, we see the time value is getting lower. And the same thing happens here. As we go deeper out of the money on the call side and deeper in the money on the put side, time value is decreasing as well. Okay, so we have these little curves here for the percentage time value. And this is the same if you look further out in time. If you look 6 months out in time, the 355 call for Apple would probably have about a 10% time value, and as you went to lower strikes, you'd see that time value decrease. Now on the call, is the price increasing? Yeah, as we go deeper in the money down to 335, the price goes up to $24.20, but remember, $20 roughly of that is time premium. Okay, so we've got $10.90 of value at the money, which is all time premium, and it's 3.1%. Okay, so what do we want to do? We want to be buying options, especially insurance, that is in the money to give us that single-digit risk. Why wouldn't we buy out of the money? Well, because remember, the stock would need to fall 5 points, 10 points, 15 points before the insurance policy kicks in. So to get that single-digit risk, when we initially set up the position, we want to go in the money to pay for the lower time premium. Okay? Buy options in the money or out of the money to limit the cost of time premium. The income methods, we're going to sell option premium at the money to maximize the time value premium. And some income methods will take advantage of both. Income method number 6, for example, takes advantage of both selling at the money and buying out of the money as well. Okay. Now the third principle is our time decay line. I apologize for the spacing. When I realized Kurt wasn't going to be here, I had to copy and paste from another presentation to get this plugged in, so there's some spacing issues, and I do apologize for that. Well, the time decay curve of an option is similar to the radioactive decay of an element. This is where Kurt's brainstorm came from for the idea to call it radioactive trading, the radioactive decay line of a radioactive element, of course, and that's what we're going to take advantage of, too, when we're setting up our positions. When we buy 5 months, 6 months out in time, our initial time decay, that initial time decrease on the option that we paid is going to be slow. And as we get closer to expiration, it's going to become exponentially faster. This sets the second standard, of course, for buying time cheaply. Not only going in the money, as we saw, to pay for low time premium, I'm also going far out in time so I don't get stuck with that quick decay. And, of course, there's a guarantee, one guarantee in trading. No matter what you say, one guarantee in trading, as an option approaches expiration, our time value will go to 0. That is a guarantee. Okay? And so here's what we're looking at, just a static time value expiration, where we see that, let's say we had a call option, a 50 strike call that's priced at $1.87. We had 3 months to expiration. Well, we're going to see a slow time decay slope over the first 30 days. From 90 days to 60, we're going to have a low slope. And then even from 60 to 30, it's probably not going to be as pronounced, but it's in that last 30 days where it really starts to decline. And I know it was a bad idea for me to write gray on gray. So here's our slower slope of decay. A little bit quicker here between the 60 and 30 days, 2 months to 1 month remaining. And then that last 30 to 45 days, we see that rapid time decay, which works against us. So what we're going to do, and we are assuming, of course, on that little graph there, it does assume that stock price and volatility remain the same. As investors, we know this is never the case. Okay? If you do find the stock where the stock doesn't change price by more than 10 or 15 cents up or down in any given 6-month period, and it keeps the same volatility of around 40% or 50%, let me know. I would love to trade some neutral strategies on that one. Okay? However, we still want to take the principles. We know it's not the case that the stock's not going to stay at the same price, the volatility is not going to remain the same, but we still want to take advantage of this decay line in our favor when we're setting up our positions. We're setting up that initial radioactive profit machine. And although we don't know the future, we can manipulate the time value of options in our favor. When buying options, we want to buy far out on time. We want to avoid that rapid decay. When selling, we want to sell near term, don't we? When we go back to that graph that we just saw, oh, I'm sorry, folks. There we go. We want to be selling in this 30 to 45 day time range. We want that rapid decay to be working with us when we're using any of the income methods that take advantage of premium, 1, 6, 5, even potentially 3. We're going to take advantage of that rapid time decay. Now, it limits annualized costs when buying, and it increases annualized return when selling premium. Think about what Emmett asked earlier. He's looking at weekly options, selling premium and weekly options. When you look at it, on some of the stocks that offer weekly options, the ETFs, the premiums might look really low from what you're originally expecting. But if you're able to get that premium week by week by week, you're going to have a much higher annualized return. Now, it doesn't always work out that way. The stock's going to fluctuate in price. You can't assume I'm always going to sell the $3.55 call on Apple and get the same premium every 7 days. That's not going to happen. It's going to fluctuate in price. It's going to move between strike prices, and that's going to change the value that you're able to receive. And also, what we saw earlier is that buying 6 months out in time, of course, doesn't mean I'm paying 6 times the cost. On that PXP position we were looking at, the 1 month out, the July 40 strike put, for example, might have been priced at about $2. When we went out to January, we went 7 months out in time, we're not paying $14 for that premium. Right? When you go 6 months out in time, you're not going to pay 6 times the cost. The option at 6 months out in time is not going to be 6 times the cost, and that's what we're taking advantage of with the initial setup. And then when the income methods, we're going to use shorter term. Okay, so the summary of our 3 core principles. Forcing an ideal size trade. We have the profit and loss chart of an RPM here. We're buying stock and we're buying a put because we don't want to overtrade or fall into the lie of leverage that can happen with long calls, credit spreads, or diagonal spread investing. The at-the-money bell curve, I know this is kind of small here, but we're going to buy premium that is outside on the wings. We're going to look to buy insurance in the money for the put. We're going to take advantage also of buying out of the money calls in certain income methods, and we're going to be selling premium when that time value is inflated, when it's at the money. Okay? And then, of course, the red line, the radioactive decay line, we want to be buying options that are at least 5 months out in time for insurance so we don't suffer this rapid time value decay. Remember, the risk, the total at risk amount on an RPM is just the time decay. All right? Okay, I think that's basically it for now. And follow up an initial position, what do we do after we set it up? We're going to limit our losses and allow winners to run, apply the 10 different income methods, use the SIGA model for each income method to determine which one best suits our conditions, expectations, and goals. That's all discussed in the blueprint. It allows us to bulletproof the position, which we're going to take a look at in just a moment. Let's reflect back very quickly. We had 59% of our attendees say they were doing covered calls and naked puts, and 50% doing long calls and long puts, and 50% doing vertical spreads. Let me just ask this. Are you happy with your trading results over the last 12 months? Whether you're doing covered calls, you were promised that 3 to 6% return. Whether you were doing vertical spreads, maybe promised a higher percentage return, maybe 20 or 15%. How do you feel about your trading over the last 12 months? Are you ecstatic? Are you very happy? Are you making money, but you're not sure if you're making enough premium? Okay. You have mixed emotions. Kurt had mixed emotions when he first started trading. Oh, sorry about that. When he first started trading covered calls, he had a few good months of success and then lost nearly everything in the third month of trading just by following his guru's advice. Did you lose money last year? And are you ready to quit? Maybe you've just seen too many big losses, you're not getting ahead, and you're not seeing any promise of getting ahead in the near future. Russ, basic, Russ is talking about P waves and S waves here, and he says, well, theoretically, then the radioactive effect of an earthquake should dissipate, not increase. It all depends on depends on several factors, of course. And some will dissipate as they go further out in time if the bedrock is consistent, of course, right? And the P and the S waves as it goes through the same bedrock over an extended period of time. You cross a fault line, it triggers another potential fault line, or you go into a different type of bedrock or shale perhaps, maybe sandstone. It's going to have a different effect on the waves moving through. All right, left that poll open for a long time. And these are kind of what we expect to see. I'm not always happy with these poll results, but we typically see this bell curve here when we ask this poll. We've got 57% saying mixed emotions. 4% said great. Good job, guys. I'm impressed. I'm very happy for you that you've been doing well. Good job, and keep it up. You know, the old adage, if it's not broken, maybe you don't need to try to fix it. But it always helps to get more quivers in your arrow, more ideas to help you improve your trading, even if you did great last year. 22%, this is the same way I was for my first 5 or so years of trading, covered calls, diagonal spreads, and so forth. Making money but not making enough. Okay, and 17% lost money last year. Now, I'm just going to ask one more poll right now, and then we're going to jump into that silver wheaten position, and we're going to talk a little bit more about how to put this all into play. How are we going to put the 3 different core principles into play? How are we going to use it in our trading? Thanks, Glenn. Yes, more quivers in your arrows. I meant more arrows in the quivers. I can hear Kurt's words and follow him every 2 days, and I can still get his statements wrong. So thank you, Glenn. More arrows in the quiver. That's always good. Okay, let's think about this. Taking a look at your trades over the last 12 months, okay? If you limited your risk on your losers to less than 6% and still kept your winners, how would you have answered that last poll? Okay, so looking over, just thinking about your trades over the last 12 months, if you'd kept all your losses to 6% and still kept your winners, would you have said, great, I'm very happy with my results? Would you have lost, but lost much less? Would that have been the only difference between a losing year and a winning year? Or did you never risk more than 1% or 6% of your account or your trades, 1% of your account, 6% of your trades, and still lost money? Okay, how would you have done over the last 12 months if you just limited your risk to 6% and kept your winners? We touched up, there's another question that came in while you guys are answering. I'm sorry, I apologize, while you're answering the poll here. Ed wanted to know, in the blueprint, are there as many bearish setups as there are bullish, which can also be bulletproofed? Yes and no. They're not discussed in detail, Ed, but we touched upon this a little bit earlier, and I'll just recap. There are ways in the blueprint where Kurt discusses how to use this limited risk technique in a bearish market. Might not be what you think. We don't advocate doing the married call setup where you short stock and buy an in-the-money call and just reverse the income method. So income method number one, we're going to take a look at in just a minute or two. Instead of selling the call, you might think, oh, if I'm short the stock and long the call, maybe I'll short the put. Now, you can reverse the income methods if you're taking advantage of it in the bearish way. We don't advocate doing the married call setup. There's a different way to do it. And you didn't want to think in reverse. If you're bearish on the market, well, you could always open an RPM on a inverse ETF, for example. So as the market is falling, your inverse ETF is moving up in price, and now you don't have to think backwards. You apply the income methods the same way you would if you were bullish on a stock, long the stock, and had it set up as an RPM. So Ed, yes, we do discuss that in the blueprint. There are ways to approach it. Okay, this is great. So 15%, this would have made the difference between a losing year and a winning year. 35% would have said great instead of 4%. We move up to 35%. They would have been very happy. 50% of you still might have lost money, but you would have lost much less. And 5%, of course, say they never risked more than 1% of their account, and they still lost money. For those 5%, I just want to throw out the idea that maybe you're not allowing your winners to run as much. You're keeping your risk to 6%. You're not risking more than 1% of your accounts, and maybe you're closing out of the positions too quickly and not allowing them to grow. And of course, for those 5% of you that answered it, send us an email to support@radioactivetrading.com. Let us know what you're doing. Let us know what you feel is not working for you while you're keeping your risks limited, but you're still not realizing any profits on your positions. We'd love to hear from you. That's what we're here for. Okay, so what's important about this poll? Well, we're not trying to rub anything in. We're not trying to say, okay, well, haha, if you maybe traded this way, we would have done better. This is simply to illustrate the point that you answered for yourself, and that's, where do we want to be 12 months from now? When I ask you this question, November 15th, 2012, what do you want your answer to be? Do you want to be happy with your trading results? Do you want to be very happy or ecstatic with your trading results, realizing you still have most of your capital in place and you've grown your account over time, or do you still want to be in the same position? Okay? All right, let's just take that, and let me hide that now, and I have to switch. It's about time. Went a little bit further than I wanted to. Let's talk about the silver wheat and trade that Kurt promised here. Okay, let's see. I'm just going to scroll through a couple of the quick questions here. Okay, let's see. Oh, Ed, you're welcome. No problem. Let's see. Okay, all right, so we'll go through now with the silver wheat and trade. We're getting close, and then we'll handle some questions towards the end. Okay, here's our original RPM setup. This was done on May 21st, 2010. Remember that chain we looked at a little while ago? I believe we were showing the chain for May 21st. It might have been May 20th. But on May 21st, 2010, we were able to buy shares of silver wheat. This says 100. This is just, we're doing 100 shares to keep the math simple. This was really done with 300 shares and 3 puts, and we'll show that at the end. But here is our RPM setup. We purchased shares of silver wheat at $17.20, May 21st. At the same time, we bought the December 20 strike put for $4.30. Now our total invested is $21.50, $17.20 for the stock, $4.30 for the put. It looks expensive, it's in the money, but remember, we're guaranteed an exit of $20, so all we're risking is the time value, $1.50 or 7% of our initial setup. And we take a look at the profit and loss chart again. Okay, we've got our static profit and loss chart. Our break even is roughly $21.50. If we held the position for the next 7 months, all the way to December expiration, and we made no adjustments, our break even would be $21.50. We're not planning on holding it all the way to expiration. We're not planning on not doing adjustments. We're going to look for the stock to move, and then we're going to sell premium against it. Now, some people will ask, why don't you sell a call right away? You've got the stock, you've got the put. Sell your 19-strike call. Maybe sell an 18-strike call if it's got single strikes, which it does, by the way. Sell an 18-strike call and generate some premium right away to start paying down this $1.50 at risk. And there's a problem with doing that, and we're going to show why in just a moment. Now, here is our stock chart of silver wheat. Okay, May 21st, we got in right at around this period here at 1720, and over the next 30 days or so, the stock moved up in price. Moved up significantly in price. It did pull back later on, but that actually worked to our advantage. So right around mid-June, as the stock's moving up and trading closer to $20, $21 per share, it was a little bit after mid-June, June 28, 2010, SLW opened at 21.45. Remember, we bought stock at 17.20, and we bought the 20 strike put. We saw a slight gap up on 6.28. We had $1.50 at risk. So we sold to open the August call. And it's about 40 days out in time. The reason why we chose the August call in this case instead of the July call is because the August call was priced right at $1.45 with a bid-ask $1.45, $1.50, something along those lines. It was pretty much close to generating the entire at-risk premium. We could have sold the July, I think at the time, for about 70 cents, maybe 80 cents or so. But we wanted to go with the August call to almost cancel out all of the risk. So we had $1.50 at risk. We received $1.48 for selling the August 21 call. So now we only have 2 cents remaining at risk on the position. We're just about bulletproof. Now this is a similar profit and loss chart to what Emmett was referring to. This sort of looks like a diagonal calendar spread, almost akin to a vertical calendar spread, meaning using the same strike prices. Buy a far out in time January 20 strike call and at the same time sell an August 20 strike call short term. This looks similar to that, but instead of risking close to 90% or 80% of the value of the long call that we're invested, now we're only risking $2. Okay, we bought stock at 17.20. We purchased the put for 4.30. We collected $1.48, so now our total investment into the position, our total monetary value into the position right now is $2,002, again for only 100 shares. We're guaranteed to get $20 back no matter what happens. So the maximum risk is only $2 or 0.1%, and if the stock's trading right at $21 per share at August expiration, it would work out to be about an 11.6% return. But you notice as the stock continues to move up in price, we start to fall away from that. Why is that? Well, this also goes back to the same reason why you don't want to sell a call below the put strike price with income method number 1. You don't want to sell the call too soon. You don't want to sell the call below the put strike price when you first open the RPM. Because what happens here is we've capped our gain. This is August expiration. This is the 21 strike call. As the stock continues to move up to 23, 24, 25, 26, 27, and 28, what's going to end up happening is we're not gaining positive delta. Remember at the beginning of the presentation we talked about how we set up the RPM. We always have positive delta. We lose that when we sell the call and the stock starts moving above the call strike price, because even though the stock might be trading at 25, we've agreed to give up our shares of stock at $21. So as the stock continues to move up, our put's declining in value. We're not getting any further gain out of the stock. Okay, so that's why it trails off from the maximum premium, and it looks sort of like a vertical spread or a diagonal. I'm sorry, I keep saying vertical spread. I mean horizontal spread. My apologies. A horizontal calendar spread or a diagonal calendar spread. All right. Okay, so this is what our position looked like after the first income method number 1. We reach August 20th. The initial at risk was $1.50. We sold the August 21 call for $1.48. The stock was trading around $21.05, bouncing between $20.98 and about $21.05 with the last hour to go to expiration. So we actually ended up having to buy to close the August call for about 3 cents. Okay, so we still keep, remember we sold the call for $1.48, we bought it back for 3 cents, so we still keep $1.45. So now we're down to a risk of a nickel, 5 cents per 100 shares, or 0.3%. Here is the new profit and loss chart for this RPM after January expiration. Did we generate income? Yes. Am I currently at a loss of 2%? No. This is still a December option. This is August 20th. We're still holding a December 20 strike put. This still has value. We paid $4.30 for it. We collected some premium against it. But with the stock trading around 21, this still probably has $2 or $3 of value in it. So I'm still not at risk. We could have liquidated this position for a profit if we wanted to, but we still had the expectation the stock was going to move up. It matched our SIGA model, so we're going to hold the position. Reflecting back, common mistakes with just income method number 1. It is a covered call, but we're doing it in the context with protection in place so we can't suffer the large drawdown if the stock goes against us. You don't want to sell the call too soon. You want to wait for the stock to move up after you open the RPM. You never want to sell a call below the put strike price. Remember, we had originally invested $21.50 into the position. If I had sold the 18 strike call right away, even if let's say we generated $1 by selling the June 18 or the July 18 strike call right away, I might have dropped my risk down to 50 cents on the bottom, but my risk on the upside now would have been $2.50. Why? We invested $21.50, stock plus put, collect $1 for selling the 18 call, so our total value into the position is now $20.50, and we sold an 18 call. So an investment of $20.50, short an 18 call, if the stock rockets up to 26, our put declines in value, we're forced to sell our shares of stock at 18, so we took a $2.50 risk on the upside, the direction we thought the stock was going to go. So you don't want to sell a call too soon, don't want to sell a call below the put strike price. You also don't want to sell a call with too little premium. This wasn't an issue with Silver Wheaton, but maybe if you open an RPM on a dividend-paying stock such as Kraft, for example, you might see the stock move up and think, okay, well, I'm going to sell the 35 strike call, but it's only trading for 25 cents, and maybe you only have 200 shares. Maybe it's too little bit of a premium. It's all discussed in the blueprint. All right, wait for the stock to move up in price. You want to apply an income method after the stock has made a move, not anticipating that the stock's going to make a move. Kurt always says, don't time your trades, trade time. At the money bell curve, radioactive decay line, we want to trade time. As a general rule, we want to look for the stock to move up 5 to 8% before evaluating the bullish income methods, and of course is also in the blueprint discuss when you might want to consider doing the bearish income methods or the neutral income methods. Okay? Best opportunities occur when the stock is trading right at the put strike price, especially with income method number 4, which we're going to take a look at now. So after August 20th, Silver Wheaton continues to move up in price. Do I use income method number 1 again? Am I going to use a different income method to bulletproof, or maybe one of the riskless spread trades Kurt refers to generate premium, maybe realize a little bit more upside? Well, we're going to consult the blueprint, we're going to apply our SIGA model, and we're going to take a look at the tools on power options to evaluate our position. Where do we stand right now? August 27th, Silver Wheaton is now at $22.60, and this is 2010, by the way. We have 100 shares with a new cost basis of $15.75. That's our effective cost per share is $15.75. We did pay $17.20 for it, but then we sold the call for $1.48, so we reduced our cost basis to $15.75. Total investment is $20.05, guaranteed $20 back, so we're risking 5 cents or 0.2% of our investment. Now I'm going to use income method number 4 to lock in profit. This is the only income method that's really done at a debit. Income method number 5 can be done at a debit, but it's not advised. But this is done at a debit. And why would I do an income method that's a debit? Well, it's to get a higher payout. What we were going to do, the stock was at $22.60. Total invested into the position is $20.05. Stock plus put minus the call premium we received. We're going to sell to close our December 20 put for $1.10. This would take our cost basis from $20.05 down to $18.95, but we do not have a put option in place. So with income method number 4, we're going to sell to close our put and buy to open a higher strike put. What does that take advantage of? The at-the-money bell curve. We're selling the call, our original put, we're selling to close our initial put, which was at the money, so it has swelled in price. Not the whole premium, but the time value. When the stock's trading at the put strike price, the put's going to have the highest time value that it'll probably ever have over the life of the option. So we're going to sell that now. We bought into it cheaply. We're going to sell into it. It's below what we paid. Remember, our original risk was $1.50, which was the time premium, but we're selling to close it for $1.10. So, okay, we give up a little bit, about 40 cents of the time premium there, but that's okay. And we're going to roll now. We're going to sell to close the December 20 put, buy to open the December 24 put for $2.70. Now this increases my cost to $21.65. Well, I have a new guaranteed exit of $24. And what did we do here? We did pay $1.60 total to do this income method. We sold to close for $1.10, bought to open at $2.70, my apologies. So we added $1.60 essentially into the position. But we gave ourselves a 4-point higher payout. So now our total invested is $21.65. Worst case scenario, if the stock now collapses and drops down to $2 per share or $1 per share, we're guaranteed to get $24 back. So our new at risk is a negative $2.35. What does a negative risk mean? Guaranteed profit. No matter what happens, even if I disappeared from trading altogether and did nothing between now and December expiration, I'm guaranteed a profit of $2.35 or 10.9% of the investment amount of $21.65. Let's take a look here what that would look like using the custom spread tool. Remember, our cost basis of silver wheaten was lowered to $15.75. We originally paid $17.20, collected the $1.48 premium. We had purchased a December 20 put for $4.30. We're selling to close it for $1.10. Okay, so we're receiving $1.10 in, and we're going to buy a higher strike put for $2.70. Total invested is $21.65. Guaranteed exit is $24. Still have unlimited upside profit potential. We've entered no short calls now. Still have an unlimited upside profit potential if it continues to grow, if it matches our expectations. And worst case scenario is we could lose 10%. I'm sorry. We could profit only 10.9%. That's the worst case scenario. Well, can we do it again? Absolutely. In September, we did an income method number 1 and 2. We did income method number 1 again, but we bought to close the calls. The stock started to move up, but we were still able to keep 70 cents of premium. This lowered the effective cost per share of the entire position to $18.25. Remember the last page, it was the stock itself was a cost basis of $18.95 plus the new put, but with the 70-cent premium we generated, we lowered it to $18.25. Now, September 8th, we used income method number 4 again. The stock's moving up, so we were able to do it on August 27th. We were able to do it again on August 8th. Stock's trading at or around $24 per share. Sold to close the December 24 put for $2.20 and bought to open the December 27 put for $4. Well, it's a difference there of $1.80. I'm paying another $1.80 into this position, but I'm guaranteed a 3-point higher payout. Okay, so we had our cost basis down to $18.25 just for the shares of stock. That includes the roll of income method number 4. We bought the put at $4.30 and sold it for $1.10. The $1.48 premium we received for that first income method number 1, and the 70 cents premium we received for the second income method number 1 done in September. So we had a cost basis on the stock of $18.25. We had purchased the 24 put for $2.70. Now we're selling to close it for $2.20. And you say, okay, well, I don't see what happened. You lost 50 cents on the put. How is that a good move? You're losing money on the put. Well, remember, when we first did that roll to the December 24 put, the stock was at $22.60. Now the stock's closer to $24 or $25. So we gained $2 to $3 in the stock to only lose 50 cents on the put between the $2.70 and what we're selling to close it at $2.20. Buy the December 27 put for $4. Now what we've done is we've moved the position up, we've moved the position sort of in this direction, and again, that's just the static break-even at expiration. We're now guaranteed a profit of 18.7%. In the worst case scenario, if the stock now collapses from $26 or $25, drops down to $18 per share or $17 per share, we're guaranteed an 18.7% profit, and we still have an unlimited upside. Now, the stock's at $26.42, and those of you who track silver wheaten knows what continues to happen next. The stock moved up to $32 per share. We used income method number 4 again. Now this time, I might have waited too long, I'll be honest with you, but we've had some recent discussions with Ernie on what he's doing on some of his positions with income method number 4, and for Fusion members, Kurt hosts a monthly webinar for Fusion members only. And this month we might discuss some of the alternative views and some of the different ways that you can approach income method number 4. Now remember what I said, the best time to roll the put is when the stock is trading right at the put strike price. So the time value is the highest on the put that you own, and when you buy further in the money, okay, you're buying a lower time premium. I let the stock get away from me. The stock was trading at about $32 per share on November 4th. I sold to close the December 27 put for 52 cents. Now, what did I originally pay for that when we first did the last income method number 4? Oh, I'm sorry, I went forward. I wanted to go back. We originally paid $4 for the put when the stock was trading at about $26 per share. So we lost $3.50 on the put. We're going to sell to close this put for 52 cents, our December 27 put. So we lost about $3.50 on the put, but we've gained $6 in the underlying security. The stock moved up 6 points from about 26 or 25.50 to about or 26 to $32 per share on November 4th. So we gained $6 on the stock and we gave up $3.50 on the put. I'm still bullish on the stock. I still have bullish expectations. It's had a fantastic run. So I want to continue the trade, but I'm getting close to that time value decay line, aren't I? It's November 4th. I'm holding a December 27 put. So where are we? Well, we're in this zone, aren't we, of our radioactive decay line. We're in that last 30 days where we're really going to start to lose any remaining value, this 52 cents on that put option. So I want to go further out. I'm going to use income method number 4 to roll further out in time. Am I paying another net debit? Absolutely. I'm paying $3.28. I'm selling to close the December 27 put for 52 cents, buying a March 32 put for $3.80. So I'm paying another $3.28, but we're getting another $5 increase, changing our put from 27 to 32. So new position is now more bulletproof. Effective cost for the stock was at $18.75. We had purchased our December 27 put for $4. The stock's now trading up at 32, so we sell to close the December 27 put, buy to open the March 32, and down here you can see it, but let's take a better look at it. We now have a guaranteed profit in the worst case scenario if the stock now collapses of 22.9%. That's the worst case scenario, and we still have an unlimited upside profit potential, and we could still do other income methods. Were these the best income methods to use? Well, I don't know. Well, I could go back in time and go through historical trades, and sometimes I do that on my position and say, what if I would have done income method number 5 here? What if I had done income method number 6 here? I don't want to second guess it, okay, because I've followed the rules in the blueprint, the SIGA model for each income method. As silver wheaton kept moving up, I looked at that SIGA model. What are the conditions? What are my expectations going forward? What are my personal goals? And that's going to determine the action I take. Could I have continued just to do income method number 1 or income method number 6 or income method number 5 to generate premium? Sure. They just didn't match my goals at the time, and the expectation of the stock, I was more comfortable doing this income method. Kurt might have entered this trade completely differently. He might have used completely different income methods on the same time frame that I was in the position. All right. So wrapping up here, silver wheaton on November 9th, silver wheaton opens at 36. Remember, we just rolled to the 32 put. It moves up above 37. I considered income method number 4 again to roll from the March 32 to the 36. I would have guaranteed about a 28.9% return. But the stock pulled back over the next few days. It didn't pull the trigger, and the stock pulled back. And November 29th, it was around 36 again. Evaluated the same income method, but I chose not to do it. And we could have rolled from the 32 to the 36 or the 37 put. Would have taken us from that 22.9% profit to the 28.9% guaranteed return. But at this point, I'm still around, even though I'm not closing the position. If I had liquidated the RPM, let's go back one slide. After I did this income method, remember the worst case scenario is the silver wheaton position would have made 22.9% if the stock collapsed. Or we held it all the way to March expiration, did no other adjustments. I could have liquidated the position at this point for about a 49% gain. The 22.9% isn't my liquidation value right now. I'm closer to about 50% because that put I just rolled to, the 32 put, still has a lot of value remaining in it, the March 32 strike put. Okay, so long story short, on or around December 6th, the steady rise for the last few days. Silver wheaton closes above $40. I considered it again, evaluated income method number 4, didn't pull the trigger, but it was okay. December 7th, it opened above 42, and then we just exited the RPM. Okay, it kept gapping up. It had a nice run. I'd met my goals. I'd over-exceeded my goals. My stop point was really, I was going to liquidate the RPM when it hit 40. I wasn't going to try to do another income method. I wasn't going to sell a call against it, try to generate more premium. I had my goal set, my trading plan set, as described in the blueprint, that when I saw it, I was going to close it out if the stock hit 40. It just happened that it gapped up to 41, and then the next day greed got the better of me. It gapped up to 42, and I just took it at that point. Okay, so the liquidation of SLW, remember where we were? The total new cost basis for the stock with all the income method number 4 adjustments we did was $22.23. The cost of our 32 put was $380 when we just did the last roll. So this $22.23 includes all of the adjustments we've made when we sold to close the December 27, and before that when we sold to close the December 24 and bought the December 27. Our effective cost of the stock was adjusted to $22.23. We're holding a March 32 put that we paid $380 for. The total invested was $26.03 now. It's total for the stock and the current put, the adjusted stock price and the current put. Guaranteed exit of $32. Okay, so that's $5.97 guaranteed profit. A negative max risk means bulletproof. That's the worst case scenario, is it would make 22.9%. Now on 12/7, remember the total cost we just saw was $26.03. It did spike up above 42, but then it came back down. And towards the end of the day on 12/7, we were able to sell to close the stock at $40.30. That March 32 put still had $1.30 remaining in time premium. It's still far out in time option. We've still got 4 months to go. Okay, and it's a pretty volatile stock. So the total liquidation value was $41.60. Now, we had a $41.60 liquidation value. The total effective cost per share with the current put was $26.03, so that's a total realized profit of $15.57 per share, and we divide that by our last cost basis of $26.03. That was the 59.8% return on silver Wheaton. The monetary profit, of course, for 300 shares is about $4,670 with a total investment of $78.09 at the end. We did do this with 300 shares and 3 put contracts. Okay, is this common? No. Can't lie to you. This is the best RPM I've ever had. Okay, as I mentioned, I trade at any given time. I've got 4 or 5 positions open, 4 or 5 radioactive profit machines open. This is by far my best gainer, and it was in a time frame when silver Wheaton really took off. I mean, it's a 6-month period, right? We opened it on May 21st, and we liquidated on 12/7. So a little bit less than 7 months, and the stock had moved from $17.20 to $40.30. You don't see that very often. I just had to have the right timing. But what allowed me to take advantage of this? What allowed me to take advantage of these increased gains? I opened the position properly. I took advantage of the 3 core principles. When I set up the initial position, I forced myself into an ideal size trade. I applied income methods that took advantage of the at-the-money bell curve, and my initial insurance policy took advantage of the at-the-money bell curve and the radioactive decay line. And as we made the adjustments, we applied the at-the-money bell curve and, of course, the radioactive decay line to those adjustments. There was only 2 points in the entire trade. That first income method number 1 we did, and then the second one we did later in September. Those are the only 2 times we did not have unlimited upside profit potential. All the other times with income method number 4, the expectation was the stock was continuing to move up in price, didn't want to cap the upside, and wanted to further lock ourselves into a higher profit as the stock continued to move up. Okay, so that's sort of the summary there. I should have gone to the next slide ahead. Maximum risk was never higher than 7%. That's what is really important here. We opened the position where we knew we couldn't lose more than 7%. If we were wrong, and instead of the stock going from 17 to 40, it went from 17 to $5 per share, we would have only lost 7% of our entire investment. Position was bulletproofed in about 35 days, opened on May 21st. We sold the call on June 28th, that first August call, for $1.50. Combining income method number 1 and 4 to lower the at-risk amount and further bulletproof it, and then we have that return there as well. It's important not to focus on the returns. Not every RPM we discuss will come out this way, and I know many of you have seen that before. You've seen Ernie's track record, and you've seen Kurt's track record, of course. But the important thing is that the position was never at risk for more than 7%. At times, it's best not to overtrade. It's not necessary to apply an income method just because an income method is available. I could have continued to use income method number 1 as the stock moved up to generate premium, but I wouldn't have had this return, honestly. Now think about it, when we did income method number 4, when the stock had moved the first time up to about $23, about $22.60, well, if I hadn't done income method number 4 there, let's say I sold the 23 call, less than 2 weeks later the stock was trading at 26. Well, now I would have to buy that call back for $3 or $4 and then roll to a higher strike. Okay, just like with regular covered call trading, income method number 1 will cap your gain. Okay, but the SIGA model in the blueprint discusses when you would consider applying income method number 1 versus income method number 4. And also, you can tell I'm kind of fond of income method number 4, especially in this trade. Just because an income method generates income doesn't necessarily mean it's the best one for the situation. And you'll be able to see that when you go through the different income methods in the blueprint as well. And always write out your goals and expectations and stick to them. Don't try to time your trades. Trade time. Okay, that's what we want to focus on. Let me navigate over here to RadioActive Trading. As you can see, we're at the end of that presentation. You go to RadioActiveTrading.com. What I want to encourage you to do, we didn't show it in this presentation, but if you go into the Resources tab at RadioActiveTrading.com, you'll see a special offer to take two-week trial of Power Options if you're not already a subscriber or you're not already taking a trial. But we'll also want to take a look at the Trade Simulator tool as well. I don't know why this is taking so long to open up. I apologize for that. I wonder. There we go. Fantastic. Now the Trade Simulator tool, there's a little video you can watch here, a tutorial video on YouTube. And you just want to plug in the numbers here. It runs a simulation of 100 trades. Heads you win, tails you lose. What are you going to set your risks at? What do you personally set your gains at? If I'm trading covered calls, I might be using a 7% stop loss and maybe a 3% or 3.5% target return. How would that work out of 100 trades with just flipping a coin? And heads I make 3.5%, tails I lose 7% with a stop order. How would that work out? Well, you might find yourself heading into bankruptcy maybe after the first 70 or 65 trades. Play around with this and see what happens when you enter in a target range of, let's say, maybe 5-6%, something fairly reasonable, but you limit your losses to 5, 6, maybe even 7%. How is that going to work out for you? So you can just go into the Trade Simulator tool there, play around with some of those numbers, put in your numbers, and see how your trading turns out. And then what would happen if I'd limit my risk guaranteed that I couldn't lose more than 5 or 6% on any one position, but I was still able to see returns around maybe the 8% range, 9% range as the stock moves up. And you'll be able to see the results of your trades down here at the bottom. Simulation. It's not a guarantee of what you might make. It's a simulation of what might happen after 100 trades. Okay, I'm not going to go through a big promotion here or anything like that, much to Kurt's chagrin, but hey, the blueprint. It describes all 10 income methods, how to properly set up the RPM to begin with, so any position you open is forcing an ideal size trade, limiting your risk correctly based on the at-the-money bell curve and the red line. You're not risking an unconscionable amount of your account in any one trade, so you don't fall into the lie of leverage or extended losses. The blueprint, of course, is $339 plus $11 for shipping. Discusses all 10 income methods as well, when you'd want to use them, the SIGA model for each income method, special chapter on combining income methods, and of course the two questions that came in and we talked about earlier from Ed and from, I forget who the other customer was, but when we were talking about that with the with Ed there and with the other customer who asked about the negative range there. Okay, now let me. Oh, Russ, you put in a lot of questions, Russ. I'm actually going to have to review those later because we're really close. But you had mentioned the Fusion meeting. It's going to take place at the end of the month, probably after Thanksgiving. Kurt's going to host one webinar a month for Fusion investors. If he doesn't have the time, then I'll just present it, and we'll talk about the income method number 4 discussions we had. Lloyd, okay, what I mentioned, what we talked about in the blueprint, the best time to do the income methods, especially income method number 4, is when the stock's trading right at the put strike price. But there are some advantages to maybe waiting to let it go. But that's discussed in the blueprint there, Lloyd. Check it out, income method number 4. Okay? Russ asked another question, does the beta of the stock have some bearings on the type of IM to choose? Yes, it does. And that's also described in the blueprint. If you're expecting more increase in price and you want to generate some premium, you might want to consider income method number 5. Or if it's more volatile, you might consider income method number 6. Income method number 4, I feel, works with less volatile stocks and more volatile stocks simply because you're locking in a point position where you know if you're wrong and the stock collapses after the stock has made a move, you've locked yourself into probably a lower risk position or maybe even bulletproofed. A follow-up to that, in other words, the risk to yield as to which IM to use, perhaps, is there an intuitive propensity that would dictate the inner self? It really comes down to your personal feelings, your risk aversion, Russ. When you're applying the income methods, it's what are your goals and what are your expectations. That's going to determine which one suits your RPM best. You and I, Russ, could be in the same exact position. You might evaluate and decide income method number 6 is best for you. I might go with income method number 4. Is there a max risk range that you want to stay in? Yeah, discussed in the blueprint. Just focus on that, Russ, and it discusses that you want to keep it, I'm sorry, Russ, you want to keep it within essentially that 3.5 to maybe 8.5% range. Kurt and Ernie usually tend to open their positions within a range of maybe 5 to 8%. I'm usually more between 4 to 6%. Again, it's just personal preference. Russ, the track records are available on Fusion. You can see some of the basics here. If you go to radioactivetrading.com and click on track records, you can see just some of the numbers of Kurt's and Ernie's trades without the specifics. Fusion members can see the full detail of Kurt's and Ernie's trades. Okay. We get this question a lot, and even some of our blueprint owners ask this, that isn't the stock selection the most important? Now, the most important thing is limiting risk, because if you're wrong, you've kept your risk down to single digits. Russ wanted to know, does it matter much really actually being a good picker or a good trader? That even if a given bad hand can use IMs to make a silk purse out of a sow's ear. I have had a stock. This is archived. Oh, it's available in one of the video CDs that Kurt has, the Advanced Income Methods. One of my first RPMs was Office Max. I bought it at $20 per share, and I think I bought the 21 or the 22 strike put that was 6 months out. This was about 3 years ago, around April 13th, 3 years ago. I held the position, I think, until December, maybe not that long. Maybe I closed it out in November or October. I don't remember. But Office Max dropped from $20 per share to roughly $5.80 per share when I closed it. The stock had dropped 75% of its value from when I opened it. This won't happen every time, but by using the income methods, combinations of income method number 9, number 1, and income method number 4, and I think an income method number 6, I was long stock the entire time. I closed it out. The stock was down 75%, and I think I got out of it for a gain of about 1.5%. I had a profit on the position, even though I was long stock the whole time. I needed the stock to come back up in the middle. If you have a stock that's just moving straight down, you were wrong on the position. It might be better to just liquidate the position, take your 3, 4, 5% risk, and look for another position. Okay, that's discussed in the blueprint as well. There's a whole chapter on exiting RPMs. But with that position, I'm referring to the Office Max one, it essentially went down about, over time it went down about $12. It came back up to $14 or $15 per share and then dropped back down. It was that move after I was adjusting the position with income method number 9s and 1s when it hit 14 and it came back up $15. I used income method number 4 and that got me in a bulletproof and then it still dropped. David, where can we find this presentation on the website or where you email it? By 5 p.m. this afternoon, David, on RadioActiveTrading.com. If you click on free webinars and podcasts, you'll see all our archived webinars. This one will be available at the top of the list. I haven't decided what I'm going to call it yet, but you'll see the newest webinar there at the top of the list, David. It will be up by 5 p.m. Eastern Time. Oh, Guy, is there a way to use the software to find the best married put selections? Absolutely. The tools on Power Options. There are webinars in this webinar archive as well, just for the Power Options, using Power Options for radioactive tradings. In the married put menu, you can use the search tool. Kurt's default criteria that he uses to identify RPMs are available there. There's also a tool on Fusion called the RPM report, which shows those shows those default criteria that Kurt uses to help you see new RPM opportunities that match that default criteria. And on Power Options, you can customize it by putting in your stocks, what kind of stocks you would like to see, what criteria you like to use, and what risk factor you want. So yeah, the Power Options tools and tools on Fusion, the RPM report and other tools will help you find the married puts that best match your needs, Guy, and help you manage them as well, help you evaluate some of the adjustments that might be made. I apologize, ladies and gentlemen. I don't know why the page is not loading. I shouldn't keep clicking it like this, but it's not going to the webinars and podcast menu. But later on this afternoon, that's where we'll be able to see it. RadioActiveTrading.com, go to free webinars and podcasts, and you'll be able to take a look there at today's presentation. All right. right. Okay, well, we're at 1:30, ladies and gentlemen. I apologize that I went a little bit over on time. We're going to have to wrap it up here. I'll take a look at everyone's questions later on. Emmett, I'll send you an email after the presentation. I want you to take a look at one of my archived webinars here. Recently asked questions to radioactive trading, Emmett. I kind of go into a discussion there about comparing the RPM technique to other ways of opening. I think you've already seen it before, Emmett. You might have even been with me when we hosted that one live. But we want to talk about that a little bit when we look into the discussion of the diagonal spreads and if they can bulletproof that way. I know they can, but it just might take more time than you have depending on where you buy your long call option. Okay? And again, today, this is where today's presentation is going to be archived. Ladies and gentlemen, thank you so much for joining me today. Thank you so much for your questions and your feedback. Russ and Ed and Emmett as well. I'll take a look over some of the questions I didn't get time to go to during this conversation, and I'll send you guys an email when I look over some of those questions. Everyone have a fantastic day. I hope you have a fantastic week heading into November expiration, and of course after that, let's maybe just forget about trading for a while. Enjoy some Thanksgiving, enjoy some family, enjoy some friends, and move forward. But you have any questions about your positions? You have any questions about the RPM techniques? Send us an email to support@radioactivetrading.com. You can also give us a call during market hours. And, of course, there are contact links at the bottom of every page. The About Us, support@radioactivetrading.com, or you can call us at the toll-free number during market hours. We'd love to hear from you. Ladies and gentlemen, once again, thank you very much. Have a fantastic week heading into expiration. Happy trading, and we'll see you soon. Good night.